Can you start off with this sell America type of behavior that we saw earlier this month? And do you think that there is something structural out there because of what the Trump administration is doing, or what's going on with the fiscal story of the United States at the moment?
So thanks for having me on, Sherry. I do think there's potentially something structural, but what I can say for certainty is that the uncertainty shock of the Trump administration's approach to trade policy has obviously really shaken markets year to date. And we're actually up from a year ago by 9% on the S&P 500, but we're down 6% year to date. We've been down as much as 20% from the peak. So that de-escalation theme that Martin mentioned earlier, that's definitely the theme of the last week, de-escalation from lows, but still a huge amount of uncertainty out there. And I say the uncertainty shock is certain because real-world companies, particularly U.S. headquartered companies, are holding off on decisions, holding off on purchases, holding off on scheduling shipments from China or to China until they know what's happening. And that's going to have a pig in the python effect on the real economy. We've seen GDP growth estimates for the U.S. drop by more than 1%, as much as 2%, depending on the analyst. For within year 2025 GDP growth estimates, that's a huge, definite impact of development so far. And then there's a lot of uncertainty about where we go from here, with the big issue being the upcoming negotiations between the U.S. and China and possible de-escalation.
So when you manage $615 billion in global assets for your clients, where are you taking their money to? If you believe that there is something structural about Sell America at the moment.
So the three big themes across our clients, and we directly manage $630 billion, as you mentioned. We also advise on more than $17.5 trillion worth of assets with sovereign wealth funds and pension funds and insurers and other clients. And the three big themes across those clients' base are diversification, being ready to maintain rebalancing discipline as we experience further market volatility, and then trying to be ready to be an opportunistic investor if things get worse and other investors panic and there are real buying opportunities in the market. And diversification is away from U.S. exceptionalism and from all the themes and asset classes that have performed the best over the last 5 years or so. And it's worth pointing out, 5 years ago, we were in the depths of the COVID drawdown. The 10-year Treasury was trading at less than 0.6%. Oil was at $12 a barrel. We were in really bad shape 5 years ago. Since then, stock markets globally have nearly more than doubled in value. So things are better today, but we have this uncertainty ahead of us. And what's done best over those 5 years is the U.S. economy leading the G7, the U.S. stock market, the Magnificent Seven, the U.S. venture capital sector, and the U.S. dollar. And Martin opened by mentioning the U.S. dollar down 9% year to date, kind of a record loss year to date for the dollar against other major currencies. That's a big deal by itself, and that suggests that investors are no longer seeing the U.S. dollar as a risk-free asset. In a risk-off environment where there's a lot of uncertainty, they're actually moving away from the dollar. That's a big structural change over the last 30 years of capital markets history.
Yeah, so when you diversify away from the United States, how would that breakdown look like? Do you go for Europe and Asia, and what would be the ratio that you're thinking about here at the moment? And what is give us a geographical breakdown first.
So the easy decision has been to reweight towards Europe because there's actually good things happening in Europe. There's a lot of pressure from European headquartered companies on European governments to roll back regulations in Europe and get to a bit more of a common market, more similar to the U.S. But also, Germany has apparently decided as a society to engage in fiscal stimulus. And Germany has a lot of room to deliver fiscal stimulus because its debt to GDP ratio is less than 80%. It's the lowest across the G7. The U.S., by contrast, is at 100%. Japan's above 100%, both heading higher. So Germany's decision to engage in fiscal stimulus, particularly for defense spending, Germany is still the third largest economy in the world. It's the largest economy in the Eurozone. So it's not just uncertainty for the U.S. economy and a stagflationary shock in the U.S. It's also some bullishness around Europe, coming from a point in time where European PE ratios were half what we were seeing in the U.S. The tougher bets are around China, where again PE ratios have been less than half of what it is in the U.S. China's the second largest economy in the world, or first largest if we adjust for purchasing power parity, directly engaged with the U.S. around trade disputes, 125% tariffs in one direction, 145 in the other. Both sides talking about de-escalation, but not really at the negotiating table in a formal way yet. So there's a lot riding for the global economy on U.S. and China. But if China improves, China's been the one economy that's had a deflationary spiral to work out of, that's had real economic challenges, where the government's been struggling to get back to potential growth, still delivering 4 to 5% GDP growth, which the G7 would really love to have. They never touch that level anymore. But by Chinese standards, weak economic growth. So things don't have to get great in China. They just have to get better from a low base for China to pay off. But that's a tougher bet because it relies on the trade uncertainty being resolved. It relies on the Chinese government succeeding in kind of re-inflating the Chinese economy. The government's been saying the right things, but capital market participants are waiting for evidence to come through in terms of behavior, in terms of the real economy performance. So China's a tougher bet. And then another easier bet is everything else. So the emerging markets, the frontier markets, within Asia, Singapore, Vietnam, Cambodia, Indonesia, supply chains are re-weighting towards those economies. They're not being targeted with the same level of tariffs, at least in the short term, as the U.S. and China are throwing against each other. They can trade with both sides. They can invest with both sides. So even if the U.S. and China don't become more friendly, those economies stand to benefit for the long term on a relative basis. On an absolute basis, a stagflationary shock, a deflationary shock to global economy is bad for everybody. But within that, as a relative trade, the rest of the world looks pretty good.
All right, Rich, listen, there's a lot to unpack there, but I want to back up a bit. And a metaphor you used a couple of seconds ago, right, really caught my ear. Pig and a python, right? I mean, pythons, they can swallow a heck of a lot, right? But something as big as a pig might be sort of a swallow too far, right? But listen, what I'm trying to figure out is we've been looking ahead. We've been talking, looking back at the first 100 days, right? I think it's probably more important to look at what is to come the next 100 days, right? And folks are saying, look, things are bad now, all right? They don't necessarily have to stay that bad if the president eases back. He can course correct. There's still time to do that, right? Even if that is true, right, other countries, you mentioned that, rerouting supply chains, and companies have been doing that as well. How much of that is happening where it may not be as easy to course correct, right? Because, I mean, let's say you reshore to another country, your capacity, manufacturing, et cetera. You're not going to spend that kind of money and then 4 years later when it's a new president decide, oh, I guess we got to shut this down and go somewhere else. I mean, it's hard.
Yeah, it is hard, and it's happening in real time. And most real-world companies have set up what they call war rooms, or some use a less military metaphor for that, but basically a group of people who are trying to monitor the situation and figure out what to do. And it's very hard to take long-term investment decisions without knowing our long-term equilibrium. If we thought with certainty the long-term equilibrium is 10% tariffs out of the U.S. against everybody, maybe slightly higher tariffs between the U.S. and China, and then we drive on, investors could get used to that reality. And even though an economist would say that's not optimal, most economists believe in free trade, no tariffs. But even if economists would say that's not optimal, the world could get on with it. The big challenge right now is the uncertainty, not the final resting point. And part of that is real world companies have to decide where to base production and where to ship from. Yep. And there are relative value differences. There's money in the ground. There's inertia. So changing your existing supply chain, getting whipsawed, it's just not a pleasant environment for real world companies right now.